Introduction. Hello and welcome to the Invest and Smart channel. My name is Vincent. Today, I'm going to introduce you to one of the most profitable and easiest ways to invest in the stock market if you're American and a beginner like you. Imagine being able to grow your money tax-free for decades, then retire without paying any taxes on your earnings. Sounds too good to be true? Welcome to the Roth IRA. Présentation. In this video, I'm going to introduce you to one of the most powerful yet surprisingly underutilized investment tools available to Americans, the Roth IRA. Even if you've never invested before, don't worry, we'll start from scratch. Who this video is for? This guide is for beginners. You may have heard about Roth IRAs from a friend or seen them on TikTok or Reddit. But what exactly are they? How do they work? What can you invest in? And most importantly, how do you get started? What the video contains. We'll explain everything step by step. What is a Roth IRA? How much money can you contribute in 2025? What to invest in with concrete examples. How to open your account. A demonstration of how to buy your first index fund. And how to avoid costly mistakes. Why it's important now. If you're young or even if you're starting late, the Roth IRA offers you a unique opportunity to grow your investments for 10, 20 or 30 years or more without ever paying a single dollar of tax on your profits. By the end of this video, you'll know exactly how to grow your money, tax-free, starting with just $50 a month. So grab a coffee, take notes if you want, and let's make your future proud of you. Module 1, Investing. Turn 1, What is a stock? Let's start from the very beginning. What is a stock? When you buy a stock, you're buying a tiny piece of a company, a slice of ownership. That means if you own one share of Apple, you literally own a small piece of Apple Inc. It's like being a silent business partner. You don't manage the company, but if the business grows and becomes more valuable, so does your share. How do you make money in the stock market? There are two main ways people make money from stocks. Capital gains. This means buying low and selling high. Example. You buy one share of Microsoft for $100 and later sell it for $150. You just made a $50 profit. Dividends. Some companies pay part of their profits to shareholders every few months. For example, Coca-Cola pays dividends regularly. If you own shares, you'll receive small payments even if you don't sell the stock. Some investors focus on growth stocks like Amazon, Tesla, while others prefer dividend stocks like AT&T or Johnson & Johnson. The Roth IRA lets you benefit from both with zero tax on either gains or dividends if you follow the rules. What's an index fund? Now, buying individual stocks can be risky because if one company crashes, your investment can tank. That's why many beginners and even professionals prefer to invest in index funds or ETFs. An index fund is a basket of hundreds of companies all grouped together. When you invest in it, you're buying a small piece of each company in the basket. Example, the S&P 500 is an index that includes the 500 largest public companies in the US. Apple, Google, Amazon, Microsoft, etc. If you buy an ETF like VOO or SPY, you're instantly investing in all 500 companies at once in just one click. This spreads your risk and gives you diversification. If one company struggles, it won't ruin your entire investment. What is the stock market? So where do you buy stocks or ETFs? On the stock market, which is basically a huge digital marketplace where shares are traded every weekday. There are several major stock exchanges in the US, like the New York Stock Exchange, NYC, the Nasdaq. You don't go there physically, instead you use a platform like Fidelity, Vanguard, Charles Schwab, or even apps like Robinhood or Webull. When you buy a stock or ETF through one of these brokers, they process the order for you and connect to the market. Risk versus reward, why time matters. Yes, investing can feel risky, but here's the key to reducing risk. Team. The longer you leave your money invested, the more stable and profitable it becomes. Let's take the S&P 500 again. Over the last 40 years, it has returned an average of about 10% per year, despite crashes, wars, recessions, and pandemics. but only if you stay invested. People who panic and sell during downturns often lose money. Those who stay in long term and keep investing usually come out way ahead. Recap. The basics of investing. Here's what you need to remember. A stock is ownership in a company. You can make money through growth and dividends. Index funds and ETFs are safer because they diversify your money. The stock market is the place where trades happen. Time in the market matters more than timing the market. In the next module, we'll introduce the Roth IRA and show you how it lets you grow all these investments completely tax-free. Module 2. What is a Roth IRA? What exactly is a Roth IRA? Alright, now that you understand how investing works, let's talk about the star of this video. The Roth IRA. What is it and why does it matter so much? A Roth IRA is a special investment account created by the US government to help Americans save for retirement. But here's what makes it truly powerful. You invest with money you've already paid taxes on, and then all your future growth is 100% tax-free. That's right. No taxes on capital gains, no taxes on dividends, no taxes when you withdraw if you follow the rules. Roth IRA versus Traditional IRA. Let's compare the Roth IRA with its cousin, the Traditional IRA. With the Traditional IRA, you invest before taxes, which reduces your taxable income now, but you'll pay taxes later when you withdraw. With the Roth IRA, you invest after taxes, so you get no deduction today, but your money grows forever tax-free. So which one is better? If you're young, early in your career, or in a low tax bracket, the Roth IRA is usually the smarter choice, because you're likely to be in a higher tax bracket when you retire. Contribution limits for 2025. So how much can you put into a Roth IRA? In 2025, the annual limit is $7,000 per year if you're under $58,000 per year if you're 50 or older, thanks to the catch-up contribution. That's around $580 per month. But you don't have to max it out. Even $50 or $100 a month is a great start. Income limits. Can everyone contribute? Not quite. The Roth IRA is designed for low to moderate income earners. If you make too much money, you may not qualify directly, but there are legal workarounds like the Backdoor Roth IRA. We'll cover that later. In 2025, the income limits are approximately $161,000 for single filers, starts phasing out. $240,000 for married couples filing jointly, phase out starts at $240K. When can you withdraw from a Roth IRA? Now here's a key question. When can you actually take the money out? There are two major rules to unlock tax-free withdrawals. You must be at least 59.5 years old. Your first contribution must be at least 5 years old. If you meet both conditions, you can withdraw all your contributions and gains 100% tax-free. Can you access the money before 59? Surprisingly, yes, but with conditions. You can withdraw your original contributions at any time, with no taxes and no penalties. Why? Because you've already paid taxes on that money. But your investment gains are different. If you take them out early, you'll usually pay taxes and a 10% penalty, unless you qualify for certain exceptions, like first-time home purchase up to $10,000, qualified education expenses, medical emergencies or disability. That said, the Roth IRA is not meant to be a checking account. Use it for long-term wealth building. Why the Roth IRA is so powerful? Let me show you how powerful this is with an example. You invest $200 a month into a Roth IRA starting at age 25. You invest in an ETF like VOO, which tracks the S&P 500 and averages approximately 10% per year. At age 60, your account could be worth over $250,000, and it's all yours, tax-free. You'll owe the IRS nothing on that $250,000 portfolio. Compare that to a regular brokerage account where you'd owe 15 to 20% in taxes on the gains. Key benefits of a Roth IRA. Let's recap the Roth IRA's advantages. All growth and dividends are tax-free. You can withdraw contributions anytime. It's easy to set up online. You have full control over what you invest in. It encourages long-term thinking and financial freedom. Honestly, there's no other retirement account in America that gives this level of flexibility and tax-free growth. That's why so many financial experts from Dave Ramsey to Graham Stephan recommend it for beginners. What's next? Now that you understand what a Roth IRA is and why it's so powerful, it's time to see what you can actually invest in once your account is open. In the next module, we'll break down what to invest in. Stocks, ETFs, index fund, real estate, crypto? We'll explain what works best inside a Roth IRA and how to choose the right option for your goals. Module 3. What to invest in with your Roth IRA. What can you invest in with a Roth IRA? Once your Roth IRA is open, the real question begins. What should you actually invest in? Here's the beauty of a Roth IRA. It's not an investment by itself, it's just a container. You decide what goes inside. And what you choose to invest in will determine whether your money grows or stays flat. Stocks versus ETFs. The two main choices. Option 1. Individual stocks. You can use your Roth IRA to buy shares of companies like Apple, Tesla, Amazon, or Disney. But this can be risky. If the company drops, so does your money. Option 2. Index funds or ETFs. These are safer, diversified options that group dozens or hundreds of companies into one fund. You don't need to pick winners, you own the whole market. Beginners should start with ETFs. They're low cost, diversified, and easy to manage. Best ETFs for Roth IRA long-term growth. Here are some of the best ETFs to consider for long-term, tax-free growth inside a Roth IRA. Pierre Nouveau, Vanguard S&P 500 ETF. Tracks the 500 largest US companies. Solid historical return at 10% year, low fees. Drew VTI, Vanguard Total Stock Market ETF. Includes all US stocks, large, medium, small caps. Even broader than the S&P 500. 3SEAD, Schwab US Dividend Equity ETF. Focuses on stable companies that pay regular dividends. Great for income. 4QQ, Invesco Nasdaq 100 ETF. Tech heavy, includes Apple, Microsoft, Nvidia, Google. More volatile but higher upside. 5VET, Vanguard Total World Stock ETF. Diversified globally US plus international markets. Great if you want global exposure. These ETFs are low cost, expense ratios 0.110% and fully eligible inside a Roth IRA. Why index funds beat stock picking? Picking stocks feels exciting until it isn't. Most professionals can't beat the market consistently. As a beginner, you probably won't either, and that's totally fine. Here's a stat. Over 90% of actively managed funds underperform the S&P 500 over 15 years. So why not just own the S&P 500 itself? That's what index investing is all about. It's simpler, it's diversified, it performs well over time, and with the Roth IRA, your compound gains are never taxed. Building a simple Roth IRA portfolio. Don't overcomplicate it. You don't need 15 ETFs. You can build a great Roth IRA portfolio with just one or two of the ETFs we mentioned. Here are a few simple examples. Set and forget, 100% growth. 100% VTI or VO, balanced, growth plus dividends. 80% VTI or VO, 20% SIHD, global exposure. 70% VTI, 30% VTI, world, aggressive tech growth. 60% QQQ, 40% VO. Whatever you choose, stay consistent and invest regularly. Simulated growth. 200 month. Example. Let's say you invest 200 a month into VTI for 30 years. Assuming an average 10% annual return, here's what happens. After 10 years, approximately $38,000. After 20 years, approximately $137,000. After 30 years, approximately $395,000. And remember, with a Roth IRA, that's all tax-free. If you invest $500 a month, you're looking at over $1 million tax-free in retirement. That's the power of compound growth plus zero taxes. What about crypto, real estate, or gold? Good question. While it's technically possible to hold crypto or real estate inside a Roth IRA, it's complicated and risky. You'd need a special self-directed Roth IRA with a lot more paperwork and risk. For beginners, stick to low-cost index funds like VTI VOO, dividend ETFs like SCHD, maybe a small percent of tech growth, QQ. Summary, what to invest in to wrap up. Choose simple diversified ETFs. Avoid individual stock picking if you're new. Use low-cost providers like Vanguard, Schwab or Fidelity. Stay consistent, investing monthly is more powerful than trying to time the market. With a Roth IRA, all of your gains will be tax-free. What's next? Now that you know what to invest in, let's move to the next step. How to open a Roth IRA and buy your first ETF. I'll walk you through it live step by step using one of the major broker platforms. By the end of the next module, you'll know exactly how to open your account, fund it, and place your very first investment order. Module 4. How to open and fund a Roth IRA. Opening a Roth IRA. It's easier than you think. A lot of people think opening a Roth IRA is complicated, like you need a financial advisor or a finance degree. Good news, it's actually very easy. You can open one online in about 15 minutes with zero paperwork. Let me show you how, step by step, using 3 of the most popular brokerages: Fidelity, Vanguard and Charles Schwab. Choosing a broker. Before you begin, you'll need to pick a broker. This is the company that holds your Roth IRA and lets you buy investments. Here are 3 beginner-friendly options. Fidelity. Easy to use, modern interface, fractional shares. Website: fidelity.com. Vanguard. Great for long-term index investing. Trusted name. Website: vanguard.com. Charles Schwab. No fees, strong customer service. Website: schwab.com. For this demo, we'll use Fidelity, but the process is very similar on all platforms. Step by step. Opening your account on Fidelity. Step 1. Go to fidelity.com and click Open an account. Step 2. Choose Roth IRA from the list of retirement options. Step 3. Fill in your personal details, name, date of birth, social security number, employment status. Step 4. Link your bank account. This is how you'll fund your IRA. Step 5. Choose how to manage the account. Self-directed is best if you want to pick your own ETFs. Once you hit submit, boom, your Roth IRA is officially open. No minimum deposit required. Funding your Roth IRA. Now that your account is open, you'll want to fund it. That means transferring money in so you can invest. You can start small, $50, $100 or whatever fits your budget. You can also set up automatic monthly deposits so your account grows on autopilot. Remember, the 2025 limit is $7,000, but starting is more important than maxing out. Buying your first ETF. Now comes the exciting part, buying your first investment. Let's say you want to invest in VOO, the S&P 500 ETF. Step 1. Log into your Fidelity account. Step 2. In the search bar, type VOO. Step 3. Click on the ETF and hit trade. Step 4. Choose buy, enter the amount, e.g. $100 and place your order. And just like that, you now own the 500 biggest companies in the US through a single ETF inside your Roth IRA, growing tax-free. Setting up auto-invest optional. If you want to build wealth consistently without thinking about it, consider setting up auto-investing. Fidelity and Schwab both let you automatically deposit money each month, automatically invest it into the ETF of your choice. It's the ultimate set it and forget it strategy. Common questions when opening a Roth IRA. Do I need to invest everything right away? No, your money can sit in cash until you're ready. But the sooner you invest, the sooner it starts growing. Can I switch brokers later? Yes, you can transfer your Roth IRA to another provider at any time. It's called a custodian-to-custodian transfer. Can I open more than one Roth IRA? Yes, but the total contribution limit, $7,000, applies across all accounts combined. Summary. You're now officially an investor. Let's recap what we just did. You chose a broker, Fidelity, Vanguard, Schwab. You opened your Roth IRA online in minutes. You transferred money from your bank. You bought your first ETF like VOO or VT. Your long-term wealth journey has officially begun. What's next? Now that your Roth IRA is open and funded and your first investment is made, what's next? In the next module, we'll talk about how to manage and grow your Roth IRA over time. We'll cover rebalancing, dollar cost averaging, mistakes to avoid, and how to make sure you stay on track to build tax-free wealth. Module 5. Strategy tips. Don't just invest. Invest smart. Opening and funding your Roth IRA is the first step. But now comes the real key, how to manage it smartly over time. In this module, we'll cover the power of dollar cost averaging, rebalancing your portfolio, common mistakes beginners make, and when a Roth IRA might not be the best option, strategy 1. Dollar cost averaging DCA. Dollar cost averaging or DCA is a fancy name for a simple idea. Invest the same amount of money on a regular schedule, no matter what the market is doing. For example, 100 months every month. Whether the market is up or down, you invest anyway. Why does this work? You buy more shares when prices are low. You buy fewer shares when prices are high. Over time, this averages out your cost and reduces the risk of investing at the wrong time. Most millionaires didn't get rich overnight. They just invested consistently for 20-30 years. Stratégie 2. Rebalancing your portfolio. Let's say you start with 80% in VTI and 20% in SCHD. Over time, the market will shift and your mix might end up being 90-10 or 70-30. Rebalancing means adjusting your portfolio to get back to your target mix. Why is this important? It keeps your risk level under control. It prevents overexposure to a single sector or asset. It enforces discipline. Buy low, sell high. You don't need to rebalance every month. Once or twice a year is usually enough. Strategy 3. Mistakes to avoid. Mistake 1. Trying to time the market. Don't wait for the perfect moment, it doesn't exist. Time in the market always beats timing the market. Mistake 2. Going all in on crypto, meme stocks, or the latest hype. Remember, the Roth IRA is a long-term retirement tool, not a casino. Mistake 3. Forgetting the 5-year rule. If you withdraw earnings too early, you'll get hit with taxes and a 10% penalty. Stay informed. Mistake 4. Not investing your money. Many people open a Roth IRA and just leave the cash sitting there. A Roth IRA only grows if you actually invest. Strategy 4. Automate everything. Life gets busy. That's why automating your investments is a game changer. Here's how to do it. Set up automatic transfers from your bank to your Roth IRA. Set up automatic investments into your chosen ITA, like VTI or SCHD. This removes emotions from the process. You're no longer guessing, you're building wealth passively, like clockwork. When a Roth IRA might not be the best fit, let's be honest, the Roth IRA isn't perfect for everyone. You might want to consider other options if your income is too high. Check Backdoor Roth options. You expect to be in a much lower tax bracket at retirement. You need the money before age 59 for a house, college, etc. In those cases, a traditional IRA, brokerage account, or 401k might be more flexible. That said, for the vast majority of people, especially young professionals and first-time investors, the Roth IRA is an unbeatable tax-free growth vehicle. Summary. Build habits, not hype. Let's recap your Roth IRA strategy. Invest monthly, even small amounts. Choose one duo low-cost ETFs. Rebalance once or twice per year. Avoid speculation. Automate everything. Be patient, wealth takes time. The Roth IRA isn't a get-rich-quick scheme. It's a get-rich-slowly and safely plan. And it works if you stick with it. What's next? In the final module, we'll answer the most frequently asked questions about Roth IRAs. Can I withdraw money early? What happens if I change jobs? Can I open more than one Roth IRA? If you still have doubts, don't worry. We'll cover everything you need to feel confident managing your account for the long term. Module 6. Frequently asked questions. Can I open more than one Roth IRA? Yes, but with limits. You can open Roth IRAs at multiple institutions, for example, one at Fidelity and one at Vanguard. But your total annual contribution across all of them combined is still $7,000 in 2025. Why open more than one? Maybe you want different investment styles, or you're testing different platforms. Just remember, the total limit doesn't increase. Can I withdraw my money early? Yes, but it depends on what money you're withdrawing. Contributions, the money you put in, can be withdrawn anytime, tax-free and penalty-free. Why? Because you already paid taxes on it. Earnings, the growth from your investments, are different. If you withdraw them before age 59.5 and before the 5-year rule, you'll usually owe taxes and a 10% penalty. There are a few exceptions. First-time home purchase, up to $10,000. Qualified education expenses, major medical cost, disability. Still, the Roth IRA is best used as a long-term retirement vehicle, not a short-term piggy bank. What if I earn too much to contribute? If your income exceeds the Roth IRA limits, around $161,000 for singles and $240,000 for couples, you can contribute directly. But there's a legal workaround called the Backdoor Roth IRA. Here's how it works. You contribute to a traditional IRA. Then you convert it to a Roth IRA. There are some rules and timing tricks to be aware of, so it's best to talk to a tax advisor or follow a trusted guide online. But yes, even high earners can access Roth benefits with this method. Can I invest in crypto, gold, or real estate? Yes, but only through a self-directed Roth IRA. These allow you to invest in alternative assets like crypto, real estate, even startups. But be careful, it's more complex. There are strict IRS rules. Mistakes can disqualify your tax benefits. For most beginners, it's safer to stick with index funds and ETFs inside a traditional Roth IRA. What happens if I change jobs? Your Roth IRA is completely independent of your employer. It's not a 401k, so changing jobs has zero effect. If you have a 401k at work, you can still contribute to a Roth IRA as long as you're within the income limits. In fact, many smart investors use both. 401k for pre-tax retirement savings, Roth IRA for post-tax, tax-free growth. Can I lose money in a Roth IRA? Yes, because your Roth IRA holds investments, not guarantees. If the stock market drops, the value of your account will drop too. But historically, the market always recovers and grows in the long run. That's why the Roth IRA is best used over 10, 20 or 30 years. The key is to stay invested, even when the market is scary. What happens to my Roth IRA when I die? Your Roth IRA becomes part of your estate. You can name beneficiaries who will inherit the account. Good news, they won't owe taxes on the money, but they will have to follow distribution rules. It's called an inherited Roth IRA, and most heirs must withdraw the funds within 10 years. Make sure to add beneficiaries when setting up your account to avoid probate issues. Final recap, let's wrap up everything we've learned in this video series. A Roth IRA lets your investments grow 100% tax-free. You can start with as little as $50 a month. You don't need a financial advisor. Investing in low-cost index funds is simple and effective. Staying consistent is more important than being perfect. And yes, you can absolutely do this. Final call to action. If you found this video helpful, don't forget to like, subscribe, and share it with someone who needs to hear this. Your financial future doesn't depend on luck, it depends on what you do today. Open your Roth IRA, invest consistently, and let time and tax-free growth do the rest.